Welcome to another market update here at GHP Investment Advisors. Today, our topic is artificial intelligence or artificial hype. I am Brad Engel, the Director of Research Trading and Portfolio Analytics. Joining as usual is Christian Luton, our Chief Investment Analyst. As we jump to the disclosure page, so instead of doing a full-blown webinar like we typically do, we wanted to put something together for a quick video on the big AI trends that have been going on and that you have undoubtedly heard about. So that's kind of the topic we're going to run through. Christian actually just put out a newsletter, I think it hit yesterday, on the same exact title, Artificial Intelligence or Artificial Hype. So, if you don't get enough from this webinar, read the article. I suggest you read it anyway. It's definitely a good read. But you can find that either via email if you would have received it if you're a current client, or on our website, GHPIA.com. Next, I just want to touch on March 26th, we will be hosting an in-person event at the Inverness. We have a special guest and well-known market strategist, Liz Ann Saunders, joining us. Liz Ann is the Chief Investment Strategist at Charles Schwab, where she provides analysis, investment strategies, and market insights for individual investors. Saunders is a well-known financial expert, frequently appearing on financial news networks like CNBC and Bloomberg. And as far as I know, we will be sending out registration links next week for that. So please join us in person. It should be a very good event. It is early, but it'll be a good breakfast. So please come on out. But let's go ahead and jump right into it. So I guess to start, let's ask the question, what is artificial intelligence or AI? By definition, AI is the simulation of human intelligence in machines designed to think, learn, and act like humans. It enables computers and systems to perform tasks such as problem solving, decision making, and language understanding that typically require human intelligence. Now, that's obviously a lot of words to explain what AI is, but this is not a new concept. Artificial intelligence has been around since the 1950s. Obviously, we've come a long way with more powerful tools in the way of computers and processing and things of that nature. We are actually in the phase of artificial intelligence, which is called deep learning. And due to the computing power and things that we have now, it's come a long way and advanced dramatically. And so for this slide, we actually went out and asked AI. Jason Kittner, our trading manager over here, he dabbles in it a little bit. So we asked him to go out to AI and ask what it defines as industries affected by AI or changing by AI. And so he used Grok, which is Grok. It's X, or formerly Twitter's chat box or AI tool. So he asked, define industries affected or things that are changing due to AI. And this is what it produced. So these are artificially automated pictures. And if you look, the top left is what the system is saying maybe a new computer site would look like at your work. A lot of computers, a lot of dynamic screens, things of that nature. In the bottom left corner, you see a humanoid robot, which makes sense because we've heard a lot about that with artificial intelligence. But robots like that could be used in manufacturing and standard processes, things like that, where we sit right now. The bottom right corner is more biotech. Robots could be used to manufacture drugs or even in the new development of drugs, which they are being used now. And then in the top right, I think is one that a lot of people are familiar with, which is autonomous vehicles. And, these are becoming more mainstream or more talked about. And to be honest with you, personally, just recently, I was in San Francisco and I actually was able to ride in a Waymo, which is a self-driving vehicle. And it was amazing. I do understand the technology has a way to go, but I was riding in a vehicle that I sat in the passenger seat and had nothing to do with it. It was a little frightening, but it was a great experience. So I recommend it if you're ever in. I think LA has them and San Francisco as well. But all this leads up to kind of the brains behind the AI hype, which brings me to a name we have all heard a million times in the news, which is NVIDIA.
Yeah, Thanks, Brad. So let's kind of dive into this force behind this so-called AI revolution, which of course is NVIDIA. So they design and they develop the graphics processing units, or the GPUs for short. And this has played a very big role in the advancements we've seen in AI in just really the past few years. So obviously we're going to get a little technical talking about GPUs and CPUs here, but I promise I'm going to try to keep it simple. So historically, GPUs, they're primarily used in graphics processing. So if you think video games, or if you're a big movie buff, you think the CGI effects. However, the same capabilities actually make them great for processing graphics. It actually also makes them ideal for processing a lot of these AI workloads. And this really just comes down to something called parallel processing, which is just the ability to handle many calculations simultaneously. So kind of using an analogy here to try to help explain how these GPUs really work. So if we think about the central processing unit, or the CPU, this is really the brain of every computer. Think, the phone in your pocket, a laptop, a tablet. Think of that as like the head chef in a restaurant. So when you hit enter, the CPU then receives the command, it processes it, and it tells your system exactly what to do. So much like the head chef, the CPU oversees everything, and it really ensures that the kitchen runs smoothly. But obviously, it's one person, so it can really only focus on a few dishes at a time. So if you have a GPU, on the other hand, this would be more like having 15 sous chefs along with the head chef in the kitchen. So if you have a task that involves very heavy calculations like we see in AI processing, the CPU basically delegates parts of the workload to the GPU, or in this case, it would be the sous chefs. And this obviously allows the kitchen to speed up the process, and it allows it to prepare many dishes at one time. So this is really why the GPUs dominate AI workloads, because when they're training these very large scale AI models, I mean, we're talking about performing millions of calculations simultaneously, and GPUs are basically built for that type of work. And moving to the slide here, so two of the hottest GPUs on the market today would be the NVIDIA H100 in the top left there, and also the newly released B200. So these are the GPUs that are being put in data centers across the country, across the globe, and they're really helping advance AI capabilities. And just to give you a sense of the power behind these GPUs, so this newly released NVIDIA B200, it has over 200 billion transistors on each chip. So if you think about transistors, they're basically just like tiny little light switches flipping on and off to process information. Basically, the more you have, the more power, the more speed, and the better ability to kind of tackle these insanely complex problems. Just comparing this chip, for example, to the new iPhone 16 that was just released last fall. So the chip inside the new iPhone has around 15 billion transistors. So again, not even a tenth of what's inside this B200. And moving to the chart on the right here, so we're showing NVIDIA revenue by segment. So as you can see, the data center revenue, which would be the gold bars, you can see that's gone from just $5 billion in mid 2020 to nearly $100 billion over the past year. And this is really just showing that the demand for these GPUs continues to soar.
And so obviously Christian's chart showed how data centers have kind of become the lion's share of NVIDIA's profits or revenues. But here we're going to take a step back and look at NVIDIA's overall revenue on the left and their operating income on the right. And operating income is, your revenue minus your expenses, not accounting for interest and taxes. But what you're seeing here is you can almost see exactly when the AI boom began. And Christian, if you happen to point at it there, it was November of 2022. And this is when OpenAI released ChatGPT, which some of you might be familiar with. ChatGPT is a chatbot that when you use it, you can ask it questions and it will give you actual answers. And this differs dramatically from, Google, which most of us have used over time, where when you Google something and you ask it a question, um, say, who is the best Denver Nugget NBA player currently, it will give you a list of links to click on, and you kind of have to decide what information you want to take from that. Well, when you when you use a chat GPT and you ask it a specific question, it gives you a specific answer and it's a dynamic answer. And you can continue to ask it questions and it will continually change. So what happened here is OpenAI released ChatGPT, and as we said earlier, November 2022, it was realized that it was built on NVIDIA-based chips. And you can see the demand for it just went skyrocketed high. Christian, likes to call it, it's like a rocket ship. It's sometimes you call this a hockey stick in our industry when it goes straight up. But that was kind of the moment things changed in the AI world. Now there are other bots that are used. Gemini, which is Google's, Anthropic is another, and there are others that are being developed. But first to market was OpenAI, and obviously built on NVIDIA-based chips. So these chips were the belle of the ball, and everybody wanted them. Obviously, shows here in revenue. This made for the revenue and an operating income growth that has never been seen before. And the important thing here is that operating profit on the right actually kept pace and even outpaced revenue, which shows that as this demand came in and NVIDIA was producing these chips in high demand, um, they were doing it at a cheaper cost, which is amazing. And this is because they were first to market and they had significant pricing power. So if you look at this from a gross profit margin or a margin standpoint, on the left is gross profit margin, on the right is operating profit margin. So gross profit margin is just when you take your revenue minus your cost of goods sold, so the material that go into your chips. And you could see the dramatic jump in this right there where Christian's showing when the AI boom kind of hit. It's spectacular because this shows that, I mean, they're above 70, about 75%. So 75 cents out of every dollar goes to gross profit. And on the right, you look at operating profit margin, you can see the substantial jump in that over 60% now. So every 60 cents out of a dollar is going to operating profit margin. Um, and what is amazing about this is, we compare it here to Apple, and Apple is another hardware company, and all of us are probably familiar with Apple. Most of us probably even have an Apple phone. But you can see Apple has been a longstanding company with great profit margins, gross profit and operating profit margins. And you can see how steady those margins are. But it really puts in light what NVIDIA has done and how much uh, increase they've seen in these margins. Well, if you look at the operating profit margin on the right, you can see there is a lot of volatility in that margin. And I think that's where the question comes is, can NVIDIA show stability in these margins? And Christian will give you some insight into that.
Yeah, I think first we need to talk about who's actually buying all these GPUs from NVIDIA. So unfortunately, NVIDIA, like many companies, they don't actually disclose their exact customer list, but they actually do give us some clues in their financial statements by labeling customers A, B, C, and D. And you can see that here broken out in this pie chart. So given what we know about companies who would be in the market for these chips or GPUs, it's actually pretty easy to make some assumptions on who that might be. So these key customers to NVIDIA, so A, B, C, and D, they're likely the big cloud computing companies or really just the companies that operate massive data centers. So if we think about like an Amazon, they have their AWS or their Amazon Web Services segment. Microsoft has the Azure cloud computing segment. Google has a cloud division. Then you also have companies like Meta, who's actually, they're not in the business of cloud computing per se, but they still run massive data centers to power their platforms like Facebook and Instagram. We've all heard of them. So these companies are really using these NVIDIA GPUs for everything. So from running the kind of newer AI chatbots to the virtual assistants we're hearing about, to helping clients power autonomous systems and manufacturing. You can think content moderation, and some of the things Brad even mentioned earlier, like accelerating drug discovery, and even like self-driving technology. But together, what we want to point out, together, these just four companies, they account for nearly half of NVIDIA's total sales. So this obviously makes them very critical to this whole AI boom, and it really makes them important to NVIDIA's top and bottom line. So here's the good news for NVIDIA is that these key customers, so again, this is going to be your Amazon, Microsoft, Google, and Meta. And as you can see on this chart, we actually included a couple others that we believe are NVIDIA customers as well. That would be Tesla and Oracle. So at the moment, these companies, they really have no plans to slow down AI spending. So if we look at the bar on the right here, all six of these companies over the next 12 months plan to invest even more into AI. And if we just look at kind of narrow down on a couple companies here, so Meta alone, this would be the light blue here. They plan on increasing their capital expenditures, which, by the way, CapEx, capital expenditures, it's really just the money these companies are spending on long-term assets, like in Meta's case, their data centers. So they increased and plan to increase spending by 65% over the next 12 months to just over 60 billion. If you look at a company like Amazon here, this would be the gold. You can see that they plan to spend over $100 billion on AI infrastructure in the next year. And collectively, these just six companies are set to spend $330 billion on their AI buildouts in the next year. And just kind of for reference here, we have 2023 data. This is more than double what they spent in 2023. So that's definitely the good news for NVIDIA. However, I would say there is somewhat more bad news, and that is the level of the spending that we're seeing from these companies is becoming a much larger portion of their overall cash flow. So for example, if we just look at 2023 here, so we see Amazon, the gold, and Tesla, the dark blue, you can see that they were actually already spending a significant amount of their cash flow on CapEx. And if we look at over the past 12 months, that's actually increased for these two companies as well as the other four companies. And then if we look ahead to the next 12 months, we see that all six companies, as I mentioned, they're set to increase their spending. Every company is, except for Microsoft, plans to spend over 50% of their expected cash flow on CapEx. And you can see Microsoft here, this is the gray. They still spend, it's 46% of their cash flow on CapEx. So this, people are calling this AI arms race. It honestly does make sense for a lot of these companies, just given their massive scale. They already have billions of users, and they have tons and tons of data to train these AI models on. However, this chart is really showing that it is becoming more and more material to these companies as well as the shareholders who are going to want to start seeing returns on these investments and rather soon. And then we think about even more pressure on these companies would be like the recent emergence we've seen. It's an AI startup called DeepSeek. So they've developed AI models that rival many of these existing ones, and even the ones created by a lot of these tech behemoths shown here, except they actually run at a fraction of the cost and they require much less power. So in short, basically companies like DeepSeek, they're not spending at nearly as much on these GPUs, and they're producing similar results with their AI models. So basically, the clock is really starting to tick for a lot of these companies. If this AI spending that we're seeing fails to really deliver strong returns that these companies obviously expect, they will likely start to rethink their strategy, and it really could dramatically impact the future demand for GPUs if it doesn't play out as expected.
And to Christian's point on DeepSeek, many of you have probably read the news, but on the day that DeepSeek was announced, NVIDIA lost $600 billion in market cap that day when the stock sold off. And the overall market lost around $1 trillion in market cap that day, just from the news that, this can be done much cheaper. It's since fought back a little, or the market has, but it's interesting how something could be done so much cheaper, and the spending is still continuing. But taking a step forward into valuation. So let's dig into the price to earnings ratio a little bit here. So as we've talked about many times on these webinars, we look at price to earning ratio as a valuation metric. We have a lot that we look at, but we're just going to focus on this one for the time being. And for those of you that don't know, price earning ratio is your current price divided by your earnings per share. And there's two ways to look at it. You can look at your last 12 months of earnings per share, or you can look at forward-looking earnings per share, or estimates on your earnings. And for this chart, we're going to look at the next 12 months, so forward-looking estimates from a price to earnings standpoint. But to put that in perspective, currently, NVIDIA is trading around 54 times trailing 12-month earnings. In this scenario here, they're trading around 27 times estimated forward-looking earnings. But to kind of give a little perspective on price to earnings, which is whenever you listening to the news, you're reading a paper and you hear somebody say, oh, where a company is valued or their valuation, things like that, most of the time they are referring to a price to earnings ratio. And so let's simplify a little bit in the sense that let's say you have two companies that are very similar. They're in the same industry, maybe they're slightly different sizes or things like that, but one trades at 50 times earnings and one trades at 25 times earnings. So the company that trades at 50 times earnings, the way you can think about that is 50, I guess, would you pay $50 for $1 of earnings? Or would you rather pay $25 to receive $1 of earnings on the other company? And if you flip that and invert those numbers, you would say that $1 divided by the price of 50 is a $2 earnings yield. A lot of times people will refer to earnings yield as well. So you just invert the price to earnings ratio and you get an earnings yield. So you would get a 2% earnings yield on a 50 time PE company. If you look at that 25 times company, that is a 4% earnings yield. One divided by 25 is 4%. So you can see kind of the difference and kind of if you break it down and make it simple from a price earnings ratio. So with that being said, NVIDIA has almost been a meme-like stock in that the price has soared over the last few years. However, here you can see that the earnings and expectations have kept pace. And again, these earnings are forward-looking earnings. Analysts project what their earnings will be. Companies give guidance on what they think they're going to earn over the next 12 months, 2 years, 3 years, things of that nature. This is not typical. This is not the typical case when it comes to companies like this. Typically, when you have a lot of buying and excitement, price will increase dramatically, and those earnings might not keep pace, which drives your price to earnings ratio up, which makes it more expensive to buy that company at 50 times or 100 times earnings, as opposed to that 25 times earning company. Um, so we're just showing this chart to kind of show where NVIDIA's gone. It's the red line, and it's been volatile from a price to earnings ratio or forward-looking ratio. But also we wanted to compare it to some of the other names that are in the Magnificent Seven that are on here. You can see the kind of the stability in the other lines at the bottom on those companies who are also taking, they're reaping the benefits from this AI boom as well. But with that, these earning estimates are we're very curious about, and Christian's going to get into some depth on that.
Yeah, so as Brad pointed out, you typically do not see that. When you see this euphoria around the stock, price typically outpaces earnings. I mean, for Nvidia, we kind of pointed out though, Nvidia, they have kind of reaped the benefit and they are seeing sales and operating income growth. So despite this massive stock price rally, it's kind of interesting. The stock actually looks cheaper today than it has over much of the past few years. So you can see on this chart, which is the gold diamonds. You can see that in the left-hand side here, I'll point to it. You can see that it's actually trading in line with our large cap growth benchmark. And it's also very close to the Magnificent Seven peers, which Brad just pointed out. However, let's see if I can get this chart to work. So the reason it trades at this valuation is really due to the expectation of earnings to grow 56% over the next year. So when we compare that to companies like a Microsoft or a Google, which you can see also on this chart here, they have much more reasonable growth expectations, basically around 10 to 15%. That's when NVIDIA really starts to kind of stand out from the rest of the pack or this Mag 7. So, and just to put that in perspective, when we're talking about earnings and the multiple, so hypothetically, if we say NVIDIA earnings only grow at half of what the anticipated rate is, which would still be, by the way, phenomenal, that'd still be near 30%, the stock would actually be trading at over 40 times next year's earnings. And to kind of put that in more perspective, so Microsoft, for example, if it grows at just half of current expectations, so in this case, we see Microsoft around 11%, so around 5.5%, the stock, based on today's price, would actually just be trading at 31 times earnings. And if we look at a company like Google, that would actually be trading at just 23 times earnings, so just slightly higher than where they're at today. So when we look at it that way, we would say that the margin of safety for NVIDIA is pretty low. Basically, if expectations do not come to reality, the multiple that investors are actually paying for each dollar of earnings really expands significantly. Or as Brad described earlier, the earnings yield is actually much lower than anticipated. So kind of going back to my previous slides here, and the good news for NVIDIA is that many of their key customers, they do have plans to continue to spend for their AI build out. So maybe they can actually hit this 40 to 50% growth over the next year. However, when we look at earnings expectations even further into the future, they still remain sky high. So here we're actually showing market expectations for NVIDIA sales and operating profits out to 2028. And as you can see, it kind of clearly explains there really is no sign of slowing down. So in 2028, you can see the market expects sales around 275 billion, and you can see operating income is approaching 200 billion. So to make this sort of assumption, you really need to believe that NVIDIA customers are going to start seeing returns on this invested capital or CapEx. Of course, otherwise you would expect them to, cut back on spending or even be pressured into cutting spending by, shareholders. But you also need to believe that NVIDIA is pretty much going to remain the only game in town and have continue this significant pricing power that we've seen. Because being that estimates here are calling for operating profit and their operating margins to stay near 65%. So just to summarize here, so when we're evaluating stocks or potential investment for client portfolios, we like to think of our approach as what we call middle lane investing. So this is really just finding the right balance to achieve the best risk-adjusted return. In the case of NVIDIA, obviously the valuation we just pointed out has come down to much more reasonable levels. But when you really start to look under the hood and you factor in other operating type risks, for example, they're predominantly still a hardware business. They have little recurring revenue sources. We see sales and profits expected to grow, over 50% over the next year and beyond. We see record profit margins that basically need to be sustained and basically assume that no competition is going to step in. And we also see, maybe most importantly, that they have a heavy reliance on just a few key customers. So when you factor all these things in, you really do start to see other risks emerge. And I kind of just want to give a comparison to a company like Microsoft. So obviously we pointed out before that the valuation of these two companies is very close. However, Microsoft sells software. They also provide the infrastructure as a service through their Azure platform to hundreds of millions of customers all over the globe. So this source of revenue that Microsoft has is more recurring or subscription based. And also the marginal cost to add a new user is very minimal. So if a company like Microsoft, who again is one of NVIDIA's largest customers, let's just say they do not see meaningful returns on this recent kind of AI spending binge, or let's say they even decide to slow down spending. This is obviously going to have a very significant impact on NVIDIA's top and bottom line. And this would especially be true if we saw, competitors like an Amazon or Google also pull back on spending. Now, of course, the market's not going to be thrilled that, Microsoft might have just incinerated $100 billion. However, at the end of the day, Microsoft is still going to be running this very stable subscription, 40% margin business serving upwards of 400 million clients. So our kind of view on NVIDIA at the current moment, the biggest risk is really around a pretty simple question, which of course nobody knows the answer to, but that is really like, how many GPUs does the world really need? Because if the answer to that question is much less than expected, then NVIDIA shareholders should expect significant volatility in the years ahead.
Exactly. And I think, we talk about NVIDIA on a lot. We talk about the Magnificent Seven on some of our past webinars and how the top stocks have been driving the market. But so we're not knocking NVIDIA in the sense that it's not a good company. We think it's a fantastic company. They have a fantastic product, and they will continue to drive the market as demand for their chips is significant. But I also think that, excess profits breeds excess competition. And a lot of these other companies who are buying chips from NVIDIA are talking about making their own chips or attempting to develop chips that are similar. So again, NVIDIA is a great business, great company. But when you consider all the factors, is it still that middle of the road name that we look for at GHPIA? But I guess time will tell as things play out with earnings, if earnings can keep up. But well, anyway, We hope you guys enjoyed our kind of shortened market webinar. Again, please join us for our hosted event at Inverness coming up. Again, you will see invites going out or registration going out soon. Uh, I am Brad Engel, Christian Luton. Here's my email, phone number, his email, his phone number. Reach out anytime. We're happy to have conversations. We can have more in-depth conversations about this. And I do recommend reading his most recent piece put out. Go to GHPIA.com and give it a read, give a little bit more insight than even what we touched on here. But thank you guys for joining, and hopefully you'll catch our next one.
Thank you.